DigitalOcean stock is down 76% from all-time high from back in 2021 when these type of stocks were pumping really hard. And recently it's down 30%, while the last bottom was in October 2023. So 2 years ago, and the price was at $20 per share. Since then, it had a substantial rally, more than doubling in price, 118% until the top, and then it has come down quite a bit since then, since February this year. And I think this is an okay opportunity. We bought this stock at around 28. Let's see exactly. Let's get into eToro here. This is a small position, and I'll show you why it's a small position. But yeah, 1x leverage, never buying with leverage. Open at 28, 1st of July. So July 1st, 28. We bought it here. It was trending down, down, down. We held it through this loss. I did not have the opportunity to add more. I think this plummet in price would have been an okay opportunity to dollar cost average down a little bit, but I decided that I'm just gonna keep it as a small position. And then it went up 40% in just a week. And since then, obviously, whenever something goes violently vertical like that, price is just gonna cool off immediately. Rarely there's gonna be further action. I mean, if there is further upside action after this 40% bump, it's just gonna drop down even more violently. So this is exactly what you want to see whenever the stock goes up by a lot. Just a solid correction, a solid cool down, because it can continue to go up from there in a healthy manner. Okay, but anyway, we bought it before, and I don't really care what happens. I expect this to go up over time, over the next few years. Let's take a look at the numbers. Market cap of $2.8 billion right now, P ratio of 23, and forward P of 16. This is already very attractive. As you can see here, going from 23 to down to 16, it's a very high growth in earnings. Yeah, let's get into it. Financial income, revenue growth. 2018, they were doing about 200 million. Right now, about 800 million. Pretty solid. Let's take a look at quarterly, at the graph by quarterly. So as you can see, this type of company has no cyclicality to it. Is growing, has been growing pretty much quarter over quarter in this graph. Yeah, all of the quarters have been with an increase over the last quarter. So it's a subscription type of business that collects money very smoothly, very predictably. So just, yeah, keep that in mind. These aspects are important, not just how much they're growing by percentage, but what type of business it is. We're just trying to understand the business. So the better we understand the business, the better decision we can do with our portfolio, how much money we can allocate to it. We can compare it to our other bets that we made, other investments. So 2019, 20% growth, revenue growth. It had a few years of 35%, cooled down quite a bit, and now it's around 12 and 13%. Let's take a look by quarterly again. Yeah, so as you can see, it cooled down over a few quarters, more than a year, got down to a low of 11 in December 2023. And actually, I think this is when it hit the bottom. If you remember here, yeah, October, it hit the bottom before, probably because of the guidance, and then it just did quite well since then. So yeah, I like what I see here. Let's move on to net income. Let's take a look at the numbers. How much money are they bringing in by net income? So they were negative 2018, hovering around this negative number until 2022, and then started to get net income positive. Trailing 12 months is sitting around 126 million. So keep that in mind. That switch, it's going to help us compare some other numbers. Always take numbers and try to correlate with each other, with other numbers that you see. Try to make sense of them. What does this net income increase mean? Why were they negative, and why now? Why did they become positive now? And we're gonna take a look at the numbers here quickly. But before, let's see what's going on with shares outstanding. 2021, so they were diluting 2018, 2019, 2020, And then this looks like a merger and acquisition type of action here. And surprisingly, they started buying back shares, which is a good sign. And now, trailing 12 months, they have been on a slight increase. We're going to take a look what's going on there. Are they diluting again, or what's going on? Gross margins, 2018, 52%, on a slight uptrend, 60% right now. Nothing to get excited about, but I think this company is still growing quite nicely, and this is not the end of the story. You're not just going to stick to these numbers. As you can see here, operating margin, minus 13% 2018, minus 12 2019, minus 5 2020. So improving, and then they were positive 9%, positive 13, trailing 12 months, positive 16. So this trend has been very consistent. Let's look by quarterly, actually. Let's take a look how it looks by quarter. Yeah, all over the place, but as you can see here, one quarter they were up to 18. So expect to see higher and higher numbers from this company as time goes on. Hopefully that's what this data indicates, that they are growing nicely and started to become more and more efficient, and yeah, growing their company to a point where they are very profitable. So balance sheet, let's take a look at their cash balance 2021. Yeah, they raised a lot of capital in 2021. I'm not sure what's going on here. 1.7 billion in the bank. Nice. Nice. They diluted probably a lot, raised a lot of capital, but nice. They got money from the suckers who bought into the bubble, and then they made that acquisition. Maybe they just borrowed money and it was sitting on their balance sheet or something for a quarter, and then they made the acquisition. I don't know what's going on, but yeah, last year 400 million. Now trailing 12 months around 400 million as well. Take into account the market cap of 2.8 billion. This is a substantial number of. This is a substantial amount of cash and short-term cash that they have. Let's take a look at total debt. So yeah, they did go into debt massively. That's where they got the money. Looks like a 1.2 billion or something, but it hasn't been drastically increasing since then. I don't think this is a problem because, as we have seen, the margins have been improving. They became more and more profitable. They're going to be able to pay this down, and the net cash is, yeah, pretty much stabilized. And yeah, that's good to see. I don't think the balance sheet is not pristine, but yeah, it does not have any massive green flags, but it does not have red flags either. Just white flags all around, nothing to get excited about. So, which is good. I mean, if the company is growing, then there are no red flags in the balance sheet. That's okay. Net income, we saw this. Let's take a look at stock-based compensation. We do not want to see anything excessive going on here. So they were doing a bit over $100 million in 2022. That was a bit excessive, taking into account the fact that they were net income negative. And now they are doing less than the net income for the trailing 12 months while growing quite quickly. I think that's okay because they haven't been increasing since 2022. They've lowered that amount in stock-based compensation, and trailing 12 months is also lower than 2024. So that's good to see that they've been stabilized, and they do not have to. It looks like they're managing well with the employees that they have right now. They're not hunting for more talent. They don't need any more, I don't know, special talent in the company to grow, which is nice. And the net income is just going to grow and grow over time, while this is going to lag behind, and which will result in more cash flow for us. So free cash flow, as you can see here, it's just going to be more and more for us as time goes on. Repurchase of common stock, what's going on here? 2022, they did $600 million. What's going on here? Let's take a look at the price. So 2022, yeah, that was a very bad decision. I guess it stabilized the price for a little bit after it plummeted very quickly in the span of 2 months, 3 months by 60%. Yeah, that's pretty violent. And I guess they intervened here with some buybacks, but yeah, it's just so bad to buy it, man. When the prices are very overvalued, you're just burning money. So this is exactly what I did not want to see. I would mark this as a red flag, a bit of incompetence by the management. Buying back even 2021 351 million. That's just burning money. I mean, this is extremely bad to see. I kind of hate to see this, and this is why it's just gonna be a very, very small position of mine. 2023 they did 500 million. Again, the prices weren't, they were in the toilet, but yeah, I guess now it's the time to pour money into buybacks, not back then. I guess, yeah, let's take a look at by quarter. Are they accelerating? Do we see any type of sign that they are planning some more and more repurchases? Yeah, I guess since 2023, as you can see, a bit more. 67 million compared to 15 million from last year. So that's good. Not a massive green flag, but it's just, yeah, I did not want to see that burn of money that they did in 2021 and 2022. The management, it's possibly that they are very corrupt and greedy and not just stupid. And they just wanted to dilute here and pump up the price as much as possible so that they can get away from the company with being set up for life. A lot of corrupt management and CEOs will do that and just try to get as much money from the people who buy into the stock as possible. And then he doesn't care what happens anymore with the company. He's going to be replaced after a few years, and he's just going to be set for life, leaving with a net worth substantially more than he began his career there as a CEO. So yeah, market cap 2021, 8.7 billion, got down to about 2.4 billion, 2 billion in 2023, and now we're at 2.8. Last recent bottom, June this year, was 2.6. So I think I'm okay with this, buying this right now and keeping it until the price reaches the all-time, not the price, but the market cap. I guess it can break through this number again over time. Of course, it's going to take years and years of growth, and things might change until then. But from what we have seen right now and what we know about the company, it's very likely to happen. Valuation has come down drastically. Forward PE of 160 in 2021, down to 16 now. So now is the time to buy. When all the sheep have been slaughtered, price going up vertically, then the slaughtering of sheep has begun. Stock price plummets by 80% and has been stabilizing since then, going sideways for almost 3 years. Now is the time to buy in and make some money. I like making money from dead sheep, from sheep that have died in the market. And make no mistake, there are a lot of people, a lot of retail traders who bought in at the top with a substantial amount of money compared to their net worth in these type of companies, DigitalOcean, Zoom Info, and now they're just wrecked. Okay, they're wrecked financially. You don't get to see them because they don't give out interviews, but yeah, there were a lot of people buying into this here. Cathy Wood, pump and dump. I mean, they're still down 80%, 85%. So yeah, be careful, guys. Don't chase mania. Don't FOMO into stocks. Let's take a look at EV to EBITDA valuation metric. The ratio was 127 in 2021, down to about 16 now. Not super exciting, but it's not bad either. Can it go down some more? I would say yes, it can, but we're not trying to get the greatest bargains of all time here. We're just trying to buy decent companies, good high quality companies, actually not decent companies, high quality companies, companies that are growing at a decent price. And this price is more than decent. I would say it's in bargain territory because it's still growing double digit top line and all of the metrics are improving. So that's pretty good to me. This 16 is probably become a 12 next year with the share buybacks and the earnings growth. But yeah, anyway. Return on capital invested, same story as with margins. They were negative 2019, turned that around. Now they're at 5, but the trend will continue. This is a violent trend, as you can see. Improved 1 year, 2 years, 3 years, 4 years, 5, 6, 7. Probably it's going to improve again, 7, 8, 9, until we see some kind of stabilization in the number. And then we can say, okay, it has been stabilized. It did not grow for the past 3 or 4 years. We can assume that it can go down from there or remain flat or slight chance to grow. But as we look at the numbers here, it's just going to continue to grow. All the metrics, gross margins, all the margins, return on capital invested, ROC as well. FCF field, how much we're paying it compared to the free cash flow, 3.8% trailing 12 months. Again, nothing to get excited. Not a crazy bargain, but it's still cheaper than the market, and I just have it here as a small position. How much is relative to my portfolio here? Let's take a look. 0.8%. I invested 0.79 and sitting at 0.8%. And I'm probably not going to add more to it. If this becomes 1.5%, 1.7%, I might shave off quite a bit from it. But yeah, that's the plan. So yeah, that was pretty much it.